Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to talk about Nvidia stock. I will explain why I believe Nvidia is finally undervalued again. Specifically, I will talk about whether Nvidia stock is a buy over the long term. As always, I would like to give you more context first. If you have been following my channel for a while, you may remember that I have been very bullish on Nvidia since 2021, even before ChatGPT came out. Here you can see that I've made many stock analysis videos about Nvidia since August 2021. Of course, past performance does not guarantee future results, but if you bought Nvidia stock since my first Nvidia stock analysis video and held it until now, you would be up by around 370%. And if you bought Nvidia stock right after ChatGPT came out and held it until now, you'll be up by more than 500%. At the time of making this video, the market is very fearful again, mostly because of macro headwinds. Many tech stocks have dropped quite a lot since the most recent peak. For example, the Nasdaq 100 QQQ ETF is still down quite a lot from the most recent peak. I believe many tech stocks are likely oversold or even undervalued now. Nvidia stock is also down quite a lot from its most recent peak because the market is concerned that Nvidia's biggest customers, such as Microsoft, Meta, and Google, may slow down their capex spending on Nvidia's AI GPUs and AI systems if they're not getting high enough return on investments or ROIs. The market is concerned that the very high capex on AI infrastructure is not sustainable. I will talk about this throughout this video. Also, right before I started making this video, a Bloomberg article stated that the US Department of Justice has sent a subpoena to Nvidia because of potential anti-competitive behaviors. Interestingly, Nvidia denied receiving a subpoena from the US Department of Justice. This suggests that this Bloomberg article was likely another fake news. Right now, many fears are affecting the entire market and not just Nvidia. The best time to invest in a great company for the long term is when there's a lot of fear in the market. So in this video, I'm going to analyze Nvidia stock and explain why I believe Nvidia is likely undervalued now. I will talk about whether I think Nvidia stock is a buy over the long term. You will learn about these topics in this video: Nvidia's financial review and biggest risks to consider, Nvidia's long-term growth prospects, Nvidia stock valuation, and whether I will buy Nvidia stock. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing in for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. First, let's talk about Nvidia's financials and the biggest risks to consider. As you may already know, Nvidia has had exceptionally high growth rates almost every quarter since ChatGPT came out in November 2022. Nvidia's total revenue, operating income, and free cash flow have grown substantially since 2022 because of the enormous demand for Nvidia's AI chips that are needed to train and infer the most advanced large language models (LLMs) from OpenAI, Google, Meta, XAI, and Anthropic. During the same period, Nvidia's operating margin and free cash flow margin also grew substantially. Of course, Nvidia's triple-digit hypergrowth rates in recent quarters will not be sustainable. From 2022 to 2023, Nvidia's revenue grew 126%. Nvidia's revenue grew from $27 billion in 2022 to nearly $61 billion in 2023. This year, Nvidia's revenue is expected to grow 103%. This means Nvidia's revenue is expected to grow from $61 billion in 2023 to around $124 billion in 2024. Of course, Nvidia's revenue base is much larger than 2 years ago. Nvidia's revenue is expected to be around $120 billion this year. This means Nvidia's revenue growth will likely slow down much more going forward. For example, according to Wall Street analyst estimates, Nvidia's revenue is expected to grow by around 39% year over year in 2025. Of course, this expected revenue growth rate is still very strong, especially for a mega cap company that will likely earn more than 120 billion in annual revenue starting this year. If you compare Nvidia's expected growth rates this year and next year, you will notice that Nvidia's growth rates are even higher than most AI software companies that are much smaller, such as Palantir, Salesforce, and ServiceNow. But here's the deal. We have to expect that Nvidia's revenue growth will slow down to a much more reasonable level going forward. Nvidia's revenue growth likely peaked earlier this year. According to lead tech analyst Beth Kindig from IO Fund, her team has estimated that Nvidia's quarterly revenue will decrease from 122% year over year in the recent Q2 quarter to around 45% year over year by the first quarter of next year. Beth Kindig from the IO Fund was one of the few analysts who predicted Nvidia's enormous growth in AI several years ago, even before ChatGPT came out, so she has been very accurate in predicting Nvidia's long-term growth over the years. Here's the important part you should know. Nvidia's most important business is its data center business. Nvidia's data center business is already contributing more than 80% of the company's total revenue. For example, in the most recent quarter, Nvidia's data center business contributed about 87% of the company's total revenue. In comparison, Nvidia's gaming business contributed about 10% of the company's total revenue, and the other businesses contributed about 3% of the company's total revenue. Nvidia's data center business will continue to drive the most revenue growth and the most profit growth going forward because we're still at the early stage of the current AI investment cycle. Right now, there's an enormous demand for Nvidia's AI chips and AI systems that are needed to train and infer the most advanced large language models from OpenAI, Google, Meta, xAI, Anthropic, and thousands of other AI startups. This year, Nvidia's total value is expected to reach more than 120 billion. Here is another important part you should know. Nvidia's data center revenue growth this year is still mostly driven by Nvidia's current gen Hopper platform. Nvidia's management stated that Hopper shipments are expected to increase in the second half of this year. This means Nvidia will earn more revenues from Hopper in the second half of this year compared to the first half. Moreover, Nvidia will start shipping a very small number of Blackwell systems starting in Q4 this year. Blackwell will generate several billions in revenue in Q4. Blackwell AI chips and systems are more expensive than Hopper AI chips and systems. Nvidia stated that the demand for Blackwell is well above supply and that this supply constraint is expected to continue into next year. Also, Nvidia's purchase commitments for inventory and capacity rose around 58% quarter over quarter to 27.8 billion. So all these guidance and financials suggest that Nvidia will continue selling a lot of Hopper this year and start selling a lot more Blackwell starting next year. Based on my estimates, I believe Nvidia's total revenue will reach slightly over 120 billion this year because of the very large demand for the current gen Hopper platform and the next gen Blackwell platform that will start shipping in Q4. Nvidia's management gave this guidance. Nvidia expects its full year gross margin to be in the mid 70% range or around 75%. This 75% gross margin is slightly lower than the previous 78% gross margin earlier this year. The biggest reason is that Blackwell has some yield issues earlier in Q2. Nvidia had to change the photo mask to improve Blackwell's production yield. Realistically, if you compare Nvidia's 75% gross margin to that of other semiconductor companies, Nvidia's 75% gross margin is still one of the highest in the semiconductor industry. About 1 month ago, a news article from The Information claimed that Nvidia would delay its Blackwell by 1 or 2 quarters because of certain design issues, which would affect Microsoft, Google, and Meta's deployment of Blackwell systems. This article from The Information was fake news that was hugely exaggerated. In the recent Q2 quarter, Nvidia stated that Blackwell is not delayed at all. Nvidia had to change the Blackwell GPU's photo mask to improve the production yield, so this is not a design issue at all. Blackwell's functionality stays the same. This is the opposite of what the information article initially claimed. We shipped customer samples of our Blackwell architecture in the second quarter. We executed a change to the Blackwell GPU mask to improve production yield. Blackwell production ramp is scheduled to begin in the fourth quarter and continue into fiscal 2026. In the fourth quarter, we expect to ship several $billion in Blackwell revenue. Hopper demand is strong, and shipments are expected to increase in the second half of fiscal 2025. Jensen Huang said the same thing during the recent earnings call. The change to the mask is complete. There were no functional change necessary. The functionality of Blackwell is as it is. Let's talk about the biggest risk that is affecting Nvidia right now. ROI on AI investments is the biggest concern for many investors right now. As I mentioned earlier, the market is concerned that Nvidia's largest customers are overspending their capex on Nvidia's AI GPUs and AI systems. For example, in recent quarters, Microsoft and Meta have spent more than 40% of their capex on Nvidia's AI systems. The market believes that Nvidia's biggest customers such as Microsoft, Google, Meta, Amazon, Tesla, and XAI may not continue their large investments in Nvidia's AI systems if the return on investments or ROIs are not high enough. Jensen Huang said this in the most recent earnings call. He explained that his customers are already getting ROIs right away by switching from their capex investments from general purpose computing to Nvidia's accelerated computing platform. There are many reasons. The first main reason is that the performance scaling of traditional server CPUs has slowed down significantly compared to GPUs in recent years. Moreover, traditional server CPUs are not energy efficient enough to accelerate very compute-intensive applications such as data processing, scientific research, and generative AI applications. In comparison, Nvidia's accelerated computing platform is much more powerful, more energy efficient, and more cost-effective in very compute-intensive applications such as training and inferring large language models or LLMs. And the second main reason is that we're moving from the traditional human engineered software to more AI engineered software going forward, which will require much more AI compute and AI systems. Jensen Huang said this.
The people who are investing in NVIDIA infrastructure are getting returns on it right away. It's the best ROI computing infrastructure investment you can make today. And so one way to think through it, probably the easiest way to think through it is just go back to first principles. You have $1 trillion worth of general purpose computing infrastructure, and the question is, do you want to build more of that or not? And for every $1 billion worth of general purpose CPU-based infrastructure that you stand up, you probably rent it for less than $1 billion. And so, because it's commoditized, there's already $1 trillion on the ground. What's the point of getting more? And so the people who are clamoring to get this infrastructure, one, when they build out Hopper-based infrastructure and soon Blackwell-based infrastructure, they start saving money. That's tremendous return on investment. And the reason why they start saving money is because data processing saves money. Data processing is probably just a giant part of it already. And so recommender systems save money, so on and so forth. Okay? And so you start saving money. The second thing is everything you stand up are going to get rented because so many companies are being founded to create generative AI. And so your capacity gets rented right away. And the return on investment of that is really good. And then the third reason is your own business. You want to either create the next frontier yourself or your own internet services benefit from a next generation ad system or a next generation recommender system or a next generation search system. So for your own services, for your own stores, for your own user generated content, social media platforms, for your own services, generative AI is also a fast ROI. And so there's a lot of ways you could think through it, but at the core, it's because it is the best computing infrastructure you could put in the ground today. The world of general purpose computing is shifting to accelerated computing. The world of human engineered software is moving to generative AI software. if you were to build infrastructure to modernize your cloud and your data centers, build it with accelerated computing Nvidia. That's the best way to do it.
I believe what Jensen Huang said is true. There are many ways companies can earn value from their AI investments. The first way to earn higher ROI is to rent out the AI infrastructure. This means renting AI GPUs to other companies that need to develop their own AI models and AI applications. According to Nvidia's estimates, for every dollar that's spent on Nvidia's AI GPUs and networking systems, Nvidia's customers can earn around $5 in rental value over 4 years by renting out Nvidia's GPUs to other companies, such as AI startups and enterprises that need to train and develop their AI models and applications. Other than providing the AI infrastructure, customers can earn higher ROI by providing AI inferencing services to other companies, or they can develop their next-gen LLMs that they can license to other companies, or they can develop their AI applications for internal use, so they can improve their existing services and to increase their employees' productivity. Ian Buck, who is Nvidia's VP of Accelerated Computing, said this at a recent technology conference. And of course, infrastructure is hugely profitable. For every dollar a cloud provider spends on buying a GPU, they're going to make it back at $5 over 4 years. The second thing we're seeing is growth in token serving. Just building and providing AI inference, whether it be a Llama or a Mistral or Gemma, and providing it to the community's users to serve tokens. Here, the economics are even better. So for every $1 spent, there's $7 earned over the same time period and growing. Now let's consider this. If Nvidia's largest customers, such as Microsoft, Meta, Google, Amazon, Tesla, and XAI, are not getting high enough ROIs, why would they continue buying Nvidia's current-gen Hopper and the next-gen Blackwell systems? I will talk more about this later on in this video. Let me show you Nvidia's balance sheet. At the time of making this video, Nvidia has a strong balance sheet. According to the most recent quarter, Nvidia had $34.8 billion in cash equivalents and marketable securities. In comparison, Nvidia had $9.8 billion in total debt and operating lease liabilities. This means Nvidia can pay off all its debt and operating lease liabilities in advance and still have approximately $25 billion in cash left. Now, let's talk about Nvidia's long-term growth prospects, so you will know whether Nvidia will still be the leader in the AI server market in the long term. I showed you this growth forecast earlier. Nvidia's revenue growth is expected to peak this year. It's not possible for Nvidia to continue growing its revenue by over 100% each year, when its annual revenue is expected to be over $120 billion this year. Nvidia's revenue growth is expected to slow down to more reasonable double-digit growth rates over the next several years. If you want to know about Nvidia's expected growth rates in the upcoming quarters, you have to look at the semiconductor supply chain. Specifically, you have to look at TSMC's most advanced chip packaging technology, chip on wafer on substrate or CoWoS. Nvidia outsources all its AI chip manufacturing and advanced chip packaging to TSMC. Here's the most important part. According to this article from Taiwan, Dr. Zhang He from TSMC has confirmed that the annual compound annual growth rate of TSMC's CoWoS capacity will grow more than 50% from 2022 to 2026. Moreover, he expects TSMC to continue expanding its CoWoS capacity until at least 2026. This CoWoS capacity growth suggests that Nvidia will continue to have high double-digit growth rates over the next 2 to 3 years, because around 70% of CoWoS capacity is for Nvidia's AI GPUs. TSMC's management said the same thing during the recent earnings call. TSMC CEO said this: "I also try to reach the supply and demand balance, but I cannot today. The demand is so high. I had to work very hard to meet my customers' demand. We continue to increase. I hope sometime in 2025 or 2026, I could reach the balance." Talking about category of those kind of increase of the CoWoS capacity, now it's out of my mind. We continue to increase whenever I can. The supply continue to be very tight all the way to probably 2025, and I hope it can be eased in 2026. That's today's situation. The last time I said that this year, I double, right? More than double. So next year, if I say double, probably I will answer your question again. Next year, it's more than double. We're working very hard. As I said, wherever we can, whenever we can. Here's the important part. TSMC manufactures more than 90% of the most leading-edge chips in the world. All the major tech companies such as Apple, Nvidia, AMD, Broadcom, Qualcomm, MediaTek, Microsoft, Google, Meta, and Tesla rely on TSMC to mass manufacture their leading-edge chips. TSMC knows the demand for AI chips, AI systems, SoCs, and other high-performance chips well ahead of most investors and Wall Street analysts. Typically, if TSMC expects that the demand for AI chips and AI infrastructure continue to be very strong, TSMC would increase its manufacturing capacity and CoWoS capacity to meet customers' demand. This is why you can see TSMC's monthly revenue has been growing at very high double-digit growth rates in recent quarters because of the very large demand for AI chips, AI systems, and high-performance computing platforms. I believe this trend will continue at least throughout this year and next year. Right before I started making this video, Elon Musk announced that his XAI team had finished building the world's largest AI data center with 100,000 H100 AI GPUs from Nvidia. Moreover, Elon Musk stated that his AI data center will double in size to around 200,000 AI GPUs from Nvidia in a few months. Elon Musk is competing with OpenAI, Google, Meta, Amazon, Microsoft, Anthropic, and all the AI startups to build the most powerful AI systems and the next-gen AI models. I believe this suggests that the demand for NVIDIA's current-gen Hopper platform is not slowing down at all. More importantly, NVIDIA expects that the demand for its next-gen Blackwell will be stronger than that of Hopper. Jensen Huang said this in a recent earnings call. He explained why the demand for Blackwell is very strong and why companies are moving from traditional general-purpose computing infrastructure to NVIDIA's accelerated computing platform in order to accelerate their data center workloads, create more revenue streams from generative AI, and lower the total cost of ownership.
The demand for Hopper is really strong, and it's true. The demand for Blackwell is incredible. There's a couple of reasons for that. The first reason is if you just look at the world's cloud service providers and the amount of GPU capacity they have available, it's basically none. And the reason for that is because they're either being deployed internally for accelerating their own workloads, data processing, for example. Data processing, we hardly ever talk about it because it's mundane. It's not very cool because it doesn't generate a picture or, generate words, but almost every single company in the world processes data in the background. And NVIDIA's GPUs are the only accelerators on the planet that process and accelerate data. SQL data, Pandas data science toolkits like Pandas, and the new one, Polars. These are the most popular data processing platforms in the world. And aside from CPUs, which, as I've mentioned before, really running out of steam, NVIDIA's accelerated computing is really the only way to get boosting performance out of that. And so that's number one, is the number one use case long before generative AI came along is the migration of applications one after another to accelerated computing. The second is, of course, the rentals. They're renting capacity to model makers, they're renting it to startup companies. And a generative AI company spends the vast majority of their invested capital into infrastructure so that they could use an AI to help them create products. And so these companies need it now. They just simply can't afford, you just raise money, they want you to put it to use now. You have processing that you have to do. You can't do it next year. You got to do it today. And so there's a fair. That's one reason. The second reason for Hopper demand right now is because of the race to the next plateau. The first person to the next plateau gets to be, gets to introduce a revolutionary level of AI. The second person who gets there is incrementally, better or about the same. And so the ability to systematically and consistently race to the next plateau and be the first one there is how you establish leadership. NVIDIA is constantly doing that, and we show that to the world and the GPUs we make and the AI factories that we make, the networking systems that we make, the SoCs we create. I mean, we want to set the pace. We want to be consistently the world's best. And that's the reason why we drive ourselves so hard. Looking forward, next year is going to be a great year. We expect to grow our data center business quite significantly next year. Blackwell is going to be a complete game changer for the industry, and Blackwell is going to carry into the following year. And as I mentioned earlier, working backwards from first principles. Remember that computing is going through two platform transitions at the same time, and that's just really, really important to keep your head on, your mind focused on, which is general purpose computing is shifting to accelerated computing, and human engineered software is going to transition to generative AI or artificial intelligence learned software.
Here's another important part that shows Nvidia is already earning consistent revenues from enterprise software. Nvidia stated that their software, SaaS, and support revenue will approach a $2 billion annual run rate exiting this year, with Nvidia AI Enterprise notably contributing to growth. To compare, Palantir's revenue is expected to be around $2.8 billion in 2024. Nvidia is still starting to earn software and SaaS revenues from its AI enterprise and Nvidia Inference Microservices, or NIM. I want to show you this product roadmap because these new platforms will drive Nvidia's growth over the next several years. This product roadmap shows that Nvidia is planning a one-year product cycle to meet customer demand and, of course, fend off competition from AMD, Broadcom, Intel, and other major competitors. Nvidia is planning to release its next-gen Blackwell platform in Q4 this year. In 2025, Nvidia will release the Blackwell Ultra platform. In 2026, Nvidia will release the even more powerful Rubin platform and the ARM-based Vera CPU. Then in 2027, Nvidia will release the Rubin Ultra platform. Of course, all these new AI chips and networking platforms will be even more powerful and more energy efficient going forward. Nvidia's next-gen Blackwell platform will be even more expensive than the current-gen Hopper platform. For example, each Blackwell GB200 superchip will cost up to $70,000, and the top-end Blackwell GB200 NVL72 server rack will cost around $3 million each. You may wonder why customers are willing to invest in Blackwell when it's much more expensive than Hopper. I'll try to explain this as simple as possible. There are several reasons. First, Blackwell's teraflops will be around 5 times more than Hopper's. Second, Blackwell will be around 25 times more energy efficient than Hopper. For example, Blackwell will require around 0.4 joules to generate each token in AI inferencing. In comparison, Hopper will require around 10 joules to generate each token in AI inferencing. Third, to train a GPT-4 model with 1.8 trillion parameters in 10 days, you will need 100,000 H100 Hopper GPUs. In comparison, you will need 10,000 Blackwell GPUs to do the same training work. Fourth, Blackwell's electricity cost for training is much lower than that of Hopper's. So if you combine the cost of buying GPUs with the cost of training and energy, you will notice that Blackwell's total cost of ownership, or TCO, is much lower than Hopper's total cost of ownership. I believe this is the biggest reason that the demand for Blackwell will be even higher than Hopper next year. As you may already know, Nvidia has had a near monopoly in the AI server market for many years. Nvidia owns around 90% of the AI server market. I believe this trend will continue for many years because Nvidia is far ahead of other competitors in everything from AI chips to large rack scale AI systems to AI software stacks. Nvidia's closest competitor is AMD, but AMD is well behind in rack scale AI systems and AI software. Even if these competitors can match Nvidia's AI chips and AI systems in performance and energy efficiency, it will be extremely hard for them to match Nvidia's proprietary parallel computing software platform, CUDA. I've said this many times before, CUDA is Nvidia's biggest competitive advantage and economic moat. Nvidia's CUDA is like Apple's iOS ecosystem. It's nearly impossible for competitors to copy Nvidia's CUDA. Based on what I know, Nvidia's CUDA is at least 10 years ahead of competitors in AI software stack and developer support. CUDA is already the largest parallel computing ecosystem and the most popular programming model for accelerating applications using Nvidia's GPUs. More than 5 million developers use CUDA. Most AI developers are trained in CUDA. Most software engineers and AI developers use CUDA to train and develop their AI models. Also, CUDA has many libraries and tools that are well optimized for many very compute-intensive workloads such as generative AI, machine learning, deep learning, data science, computational finance, and digital biology. Here's the important part. CUDA only works on Nvidia's GPUs. It does not work on AMD's GPUs or those of other competitors. This means developers and software engineers are forced to buy Nvidia's AI GPUs and AI systems if they want to accelerate their applications using CUDA. This from Seeking Alpha, it shows Nvidia's expected growth rates going forward. In terms of revenue forecast, Nvidia's revenue is expected to grow by around 106% this year. Next year, Nvidia's revenue is expected to grow by around 40%. After that, Nvidia's revenue growth is expected to slow down to the high teens. In terms of EPS forecast, Nvidia's EPS is expected to grow 119% this year. Next year, Nvidia's EPS is expected to grow by around 40%. After that, Nvidia's EPS is expected to slow down to the high teens. All these consensus forecasts suggest that Nvidia will still have very high growth rates between now and 2027. Of course, it's very hard to predict Nvidia's growth rates beyond 2027. In terms of valuation, Nvidia's forward PE is expected to be around 38 this year, which is still high. However, if you look at Nvidia's expected EPS growth next year, Nvidia's forward PE is expected to be around 27 by next year. This is very low for a mega cap growth company like Nvidia. This means Nvidia is likely undervalued now if you look at Nvidia's forward PE next year. Let me show you this intrinsic valuation model here. I always use this intrinsic value model to calculate each stock's intrinsic value. You can use it to calculate Nvidia's intrinsic value, so you will know when Nvidia stock becomes undervalued, fairly valued, or overvalued. If you want this intrinsic valuation model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Nvidia's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 10.5% here. You can use a higher discount rate here if you want to be more conservative. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe Nvidia's revenue will grow between 95% and 105% year-over-year this year. 100% year-over-year growth is the midpoint. This estimated growth is slightly lower than the consensus revenue growth this year. Of course, Nvidia's revenue growth will slow down going forward, so starting next year, I believe Nvidia's revenue growth rate will slow down to around 50% year-over-year, which is the midpoint growth. After that, I expect Nvidia's revenue growth to slow down to between 10% and 15% each year. I used a long-term growth rate of 8% to calculate the terminal value. I believe this long-term growth rate of 8% is very reasonable because the overall semiconductor market, excluding memory, usually grows by around 10% each year. Of course, if you want to be more conservative, you can use a lower long-term growth rate to calculate the terminal value. Over the next several years, I'm assuming Nvidia's free cash flow margin will decrease from around 49% this year, which is the peak, to around 40% over the next several years, because Nvidia will face more competition from AMD and other competitors. Let's go over these three case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that Nvidia's revenue will grow by around 95% this year. Next year, we're forecasting that Nvidia's revenue growth will slow down to around 45%. After that, we're forecasting that Nvidia's revenue will grow at a 10% CAGR over the next several years. Then Nvidia's intrinsic value should be around $2.76 trillion for the entire company, or $111 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that Nvidia's revenue will grow by around 100% this year. Next year, we're forecasting that Nvidia's revenue growth will slow to around 50%. After that, we're forecasting that Nvidia's revenue will grow at a 12.5% CAGR over the next several years. Then Nvidia's intrinsic value should be around $3.1 trillion for the entire company, or $125 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that Nvidia's revenue will grow by around 105% this year, which match the consensus revenue forecast. Next year, we're forecasting that Nvidia's revenue growth will slow to around 55%. After that, we're forecasting that Nvidia's revenue will grow at a 15% CAGR over the next several years. then Nvidia's intrinsic value should be around 3.5 trillion for the entire company, or $141 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Nvidia's intrinsic value should be around $126 per share. I also use a forward sales valuation model to estimate Nvidia's intrinsic value, which should be around 2.67 trillion for the entire company, or around $107 per share. If we take the average of both valuation models here, I believe Nvidia's intrinsic value should be around $116 per share. To compare, Morningstar has given Nvidia a slightly lower fair value of $105 per share. I want to show this to you. This is a preview. Right now, I'm developing a software application with a business partner. Our goal is to create the best software application that can help investors analyze stocks, find the best stocks, and calculate each stock's intrinsic value. Again, this application is in beta. This screenshot is a preview. The orange line represents Nvidia's fair value. The blue line is Nvidia's stock price. Here, you can see that Nvidia's stock has dropped below its fair value line in recent weeks. Based on my intrinsic value model and this program, I believe Nvidia stock is likely slightly undervalued now. So will I buy Nvidia stock? It depends on the price. I think Nvidia is a buy for the long term, as long as it's still undervalued below its intrinsic value. I mentioned this many times before. I actually made the mistake of selling Nvidia too early before for a quick profit. Earlier this year, I bought back many more Nvidia shares. For example, this is one of my accounts. I've bought back many Nvidia shares in this account since earlier this year. I also have more Nvidia shares in other accounts that I bought at lower prices. I'm investing in Nvidia over the long term because of several reasons. First, this year, Nvidia's revenue growth is mainly driven by Hopper and not even Blackwell yet. In Q4 this year, Nvidia is planning to sell several billion dollars worth of Blackwell chips and systems. Second, Nvidia's management has stated that the demand for Blackwell is very strong, even stronger than Hopper. Next year, Nvidia will sell many more Blackwell systems, which are even more expensive than Hopper systems. Third, TSMC's chip-on-wafer-on-substrate CoWoS capacity is expected to grow at a CAGR of more than 50% from now to 2026. So if we consider all these things, I believe Nvidia will likely have very strong revenue and earnings growth between now and 2026, especially after it starts shipping Blackwell to customers in high volume. This is my prediction. Over the longer term, I believe Nvidia will continue to dominate the AI server market and maintain over 70% of the market share because of its proprietary CUDA parallel computing platform, which is essential for building AI models and applications. Based on what I know, it's nearly impossible for competitors to copy Nvidia's CUDA ecosystem. Now, all these are only my opinions and my analysis based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.